our next guest is a very important topic. And what we're going to be talking about is what investors actually expect. These are the multifamily opportunities that are available for alpha return. So we're going to be talking with Craig Shannon. He has an extensive experience in all aspects of real estate and alternative asset capital raising, mergers and acquisitions, development and management, and brokerage. This is all across public and private markets. He's earned a reputation as a trusted advisor, thought leader, and a successful deal maker. So Craig, welcome in.
In my own mind with that introduction. But I look forward to speaking to you about the topics. Are you going to just ask me some questions, or how do you want to start?
Yeah, so what I wanted to start off with was, how do we craft that business strategy? So a lot of these sponsors and deal makers are putting deals together, and I really want to get into the hearts and minds and insights from the capital standpoint. Like you're helping companies really work through these so they can make really great decisions. But I want to talk about how do we craft that business strategy to connect with that capital. What does that look like from your vantage point?
Well, first of all, it's a great question because that's what I do. So I connect companies, and specifically their CEOs, with capital. I don't write their strategy. I don't run their strategy, but I connect them with capital. And capital, I'll make this very simple. Capital is looking to get their capital back.
Yes.
And they're not necessarily looking to invest in multi-residential real estate. They have options. And historically, capital would invest in stocks and bonds. Then you had the evolution of this thing called alternative assets, which includes real estate and other things. But capital is looking to get their money back. And they're looking to get their money back with a spread. We call that alpha. It's looking to get a spread to an equivalent risk asset. And they're looking to do it with someone they trust. And that's notionally the asset manager. That's the company. But they want to put their capital with somebody they trust. And they want to do that in a structure that works for them. So the three things, and we'll talk about these things in more detail, but very simply stated, capital is looking for alpha. So they're looking for a spread above the risk. And I like to say you can have a 5% return with a 3% risk. That's positive alpha. But that 5% return may not be high enough for some investors. A 15% return on a 20% risk is a bad deal. So don't be lured into thinking a 15% risk is a good deal. And investors are looking to invest their capital and get alpha in a strategy that's differentiated. So we'll talk a little bit multi-residential, but they may already be investing in things that are similar to what a particular asset manager is doing, say in the multifamily sector. So how is your strategy different? And can it be executed on? You can have great ideas, but can you actually deploy the capital? And if you're raising $1 or $1 million or $100 million, can you actually execute the strategy? And can you grow the strategy? Most capital wants to invest with a manager that they can have confidence with at the outset and stay with over term. And investors typically want their money back when you can't give it to them. And when you can give it to them, they don't want it back. They want to reinvest with you. So the alpha is the most important in terms of returns, but I'd say the most important part of this equation is the manager, and the least important is the structure. And I've worked on many deals, and you can change a structure. And in fact, I've done deals with not perfect structures, but if you have perfect structures and bad managers, that's a bad outcome. So the three things we'll talk about are what's the strategy and the return, who's the manager, and what's the structure. And as I said, the most important thing is the manager. But at the end of the day, we're looking to intersect what an investor is looking for from what the manager or the owner is offering. And they have to intersect. And I kind of call that the Venn diagrams, where you have that little circle in the middle of the different. And if you can intersect those things, then you have the basis of a good deal. And that means intersecting the fees, the returns, the structure, and all that stuff. And we can talk about this in some detail. So that's the kind of the simplicity of it. There's a lot of detail behind this. When we get into the deal, we'll talk about capital structure and leverage and all that stuff. I think that the multi-residential sector, frankly, is the preferred, for me, the preferred real estate asset class. And we'll talk about that. And for so many reasons, it's commodity-like. People have to live somewhere. And without a doubt, it's benefiting from very favorable winds at its back. Whether you're in Phoenix, and I've been to Phoenix and I've worked on deals in Phoenix, or you're in Toronto, where I'm sitting right now, what we're seeing is, well, let me say, real estate is driven by two things: supply and demand of two things, supply and demand of space, and supply and demand of capital. And the multi-residential sector is in a very favorable position for both of those things. There's just more demand than there is space. And I'm making a very generic statement. Obviously, you have markets and sub-markets, but on balance, and particularly for residential, there's more demand than there is space. And there is, on balance, an availability of capital. There is capital, both debt and equity. There is more equity capital than there are good places to put it. The world is awash in capital, but there aren't that many good places to put it. There are a lot of places to put it, but best-in-class managers that offer the right conditions, and I call them the winning conditions. And when I look at my clients, I'm looking for a client that actually has or can have the winning conditions. And that's by combining the things that we're talking about. It's combining a strategy that provides alpha and actually has underlying it some detail. There's a financial model. And we can, again, get into more detail about the financial model. It has a strategy that can generate the alpha, and it's executable, and that the investor looks at this manager and trusts the manager. And the manager is becoming a fiduciary for this third-party investor capital. So is this manager trustworthy? What's their track record? And I'm working on a bunch of deals right now, I literally get a criminal check on the managers. And it's not because I expect there's a problem, it's to confirm that there is no problem. And in fact, I say to my investors, the only reason you wouldn't invest in the deals that I bring you, the only reason is that you don't have liquidity for the strategy. Because everything is going to tick off. And the ticks are: who's the manager? What's their track record? How have they pivoted in the face of adversity? And we've literally taken companies public where we said in the prospectus, this company is a good company because, unlike most other companies in the space, they've never defaulted on a financial obligation. So have they defaulted on financial obligations? Or if they had a problem, and if you've been around long enough, most real estate owners and developers have had challenges. How did they deal with the challenge? Did they recover capital? Did they recover the entirety of capital? Maybe not the spread that was anticipated, but what is that track record? And what is the ability of management to pivot in the face of adversity? And arguably, to stay the same, you have to change. You certainly have to change to be competitive. And we can talk about some of those things in the multi-residential sector. So I look for managers that are passionate about what they do. They're not doing a whole bunch of other things. They have their capital involved. And how much capital? It has to be enough. And there are rules of thumb, but it has to be enough. And you can't have an amount of capital involved that you're recovering in the first year of your asset management fee. That really doesn't work for investors. So how much capital do you have? How are you recovering it? You can recover part of it through an asset management fee and maybe your property management fee or a development fee. But investors want to see that your real upside is aligned with them, which is in the performance of the investment. And that could be in the GP promote. It could be actual your LP investment in a deal or your capital investment in a deal. But these things all have to align. And if they do align, I tell you, raising capital is still hard. It's very hard. It's aligning the windows. And there may be liquidity today, but you don't have the deal. or you may have the deal, but there's not liquidity or there's not capital. So, this is kind of the art of the deal. And I'm looking for managers that are more artful in running their strategy. And if it's a multi-residential strategy, frankly, how do they run the strategy? You want to talk about that? Because I think that's maybe a more relevant topic for.
I think it's useful.
Yeah. So, what is multi-residential? And frankly, it's become so many things. But it houses what we once used to refer to as tenants. Now there's a big breakthrough. We're calling them clients. And this is a big breakthrough. I worked for a company that was a public company, and we literally sat around the boardroom table, and somebody said we should call our tenants clients. Let's put an umbrella in the lobby and give them some services. So what's the nature of the model, and how is the revenue being generated? What are the expenses, and how do you manage all these things? And I think what we're seeing increasingly in the multi-residential sector is more of a hospitality type model. And what I think is so key to that is the provision of services and the creation of community. And these things create stickiness. People want to live in places where there is a community of like-minded residents. Frankly, it might be preferable to have like-minded owner residents, but that's another topic. You want to live with people that you're compatible with, you like to get along with, and all of a sudden your landlord's providing you some services, and that stickiness allows a landlord to charge more rent. So a landlord then has to find that balance between creating stickiness and actually having some turnover, because you want some turnover. And what is that turnover? Is it 20%? 100% turnover is probably too high, and there are real turnover costs that aren't necessarily recoverable, but a 20% turnover rate is probably a good thing, and it allows you to market the turnover rents. So in a market that is improving, you want to have that turnover. I had a public client here in Canada that in this space, and they said their economic occupancy, full occupancy, was 95%. It wasn't 100%. That they needed that 5% because they were pushing rents, and they wanted the rents to be as high as possible. But that particular company, and this is a separate topic, but today, if you were to read their annual report, they have a whole section devoted to their ESG strategy and how they're working with community, how they're working with people that are coming to Canada from other countries and need help. So how do you find those balances in your economic model? And I'm not going to answer it, but I think you have to think about it. You and I have talked about having top line actually bring in some new line items. Can you generate alpha by looking at your occupants a different way? And I've been working with a company that's doing exactly that. And we looked at that a resident is paying 40 to 60% of their income in their housing costs, which means 40 to 60% is being used to purchase all their other goods and services. And how can you participate in that as an owner, as a landlord? And again, this is a question that we didn't ask that question 5-10 years ago. And today, landlords are asking that question. Can you aggregate the purchasing power of your residents? And can you give them preferred access to purchasing those goods and services? And it might be working out a deal with Uber, it might be working out a deal with your local food market, it might be working out a deal with a provider of insurance. But if you can take the aggregated population, because those people who are your residents are buying many of these services from their living room on their computer. They're renewing their automobile insurance. They're purchasing their apartment insurance. Can you aggregate it and give them a better rate and share in that? So that's kind of an example of alpha. Can you create a loyalty program? Can you create a brand around your management? And a great example of this is a real estate company that almost went bankrupt in the 1970s, based here in Toronto, called Four Seasons Hotels, which you would have heard of. It's a global company. And it almost went bankrupt as a real estate company. And it's transformed its real estate model and the actual ownership of real estate, which is very capital intensive, into a management model. And that management company trades on a very different valuation basis. And they're entering into, I mean, literally 50-year management contracts. It's a different topic, but I would argue that an owner of multi-residential or any hard asset class may want to share the ownership with someone else. And a company that does that very, very, very well, and a company I used to work for is Brookfield, which has become a global alternative asset manager. So they put their own money in, but they bring in third-party capital, and they take a share of the return of that third-party capital. So the valuation of their management company arguably might be higher than the real estate company, and it doesn't require as much capital. So different topic, but I think we're talking a little bit today about having owners of multi-residential share the ownership with others, with investors, and that can be a very, very, very desirable company. And at an extreme, you have no ownership. I think that's an extreme. I think some ownership is important. Is it 5%? Is it? But it has to be more than zero. And then you can access this capital that's out there looking for a place to go. When we talk about managing kind of the revenues, we have operating expenses, and how can you create scale, enough scale that you have purchasing power on buying toilet seats, countertops, and the like, and how can you, in aggregating your purchasing power, then pass on an advantage to your residents? Remember, the objective of any company, and the CEO of any company, is to minimize their cost of capital. That's the role. If you're running a company, you want to minimize your cost of capital, and if you can be more cost of capital competitive to your competitor, then you can pay more for the same asset and generate a return to your investors that will be acceptable. So how do you do that? It's certainly by managing the economics of your property. So we talked a little bit about the top line and generating more alpha from these other sources that many apartment owners aren't thinking about. Then how can you generate more alpha from managing your NOI margin? So your effective gross revenue less your operating expenses. And in this purchasing power, controlling your whether they're suppliers of your landscaping or the people that are supplying the things that you're putting into the suites to upgrade them or just maintain them. That's a competitive advantage. And I think you need some scale. And investors like scale because it provides diversification. As you work your way down to through an income statement, most investors want, I'd say, two things. And again, this, whether it's real estate or anything else, most investors want a dividend as opposed to tying their money up in something that's going to return to them in 3 years' time or 5 years' time. And that's the problem with real estate development. You're waiting to get your money back.
Right.
And there's a need for real estate development. We can talk about that separately. But most investors want some yield, and they want to see that there's going to be appreciation on their capital. And that's through a theoretical or actual monetization event. When I work through a model with a client, I want to see that the ability to pay a dividend is not from 100% of free cash flow. It's from something less than 100% of free cash flow. And I've got to tell you, we've taken companies public where the valuation was based upon the dividend, and we got very nice valuations, but the dividend was actually higher than the free cash flow. And that's not a sustainable model. So sophisticated investors want to see that you're paying a return that's less than the free cash flow. And free cash flow includes repayment of debt. And if you look at financial statements, it's hard to find what's the principal repayment. It's not there in an income statement. So
yeah, and they're not coming from reserves.
No, that you have the cash flow somewhere that you're going to pay this. And what I've experienced is that it used to be that companies would They thought they were minimizing their cost of capital by taking on more debt because debt is cheaper than equity. But that's changed. And I look at the public REITs that I'm familiar with in Canada, their cost of capital actually has come down as they've taken on less leverage. And so investors want to see that the capital structure is balanced, that you have some debt, but you don't have too much debt, that whatever debt you have a coverage ratio that covers it. And remember, good companies go out of business because they can't meet their short-term obligations. So it's important that your debt is kind of laddered, that it's not all coming due at one point in time. And if people are concerned about rising interest rates, it's an issue. But if you've locked in 5, 7, 10-year debt, rising interest rates are not going to affect that debt today. And arguably rates are going up because there's underlying growth in the economy, and you should be able to pass on some of that inflation, you should be, to your residents coming in. Not always, and we've lived in stagflation and in more complicated environments. So I work with clients trying to intersect these things so that the outcome works for the owner manager and for the investor. And when I've said at the beginning that the only reason you wouldn't invest in this is because you don't have liquidity, that we've worked with the owner manager on making sure that the capital structure works, that there's a financial model, that we have something that's sustainable. But then in the differentiation, what's the spin? How do you capture capital literally in a 20-second introduction? Because you really have that short period of time. A pitch deck, you've got to capture the interest of an investor right at the beginning. And I've read many pitch decks, and I've read what are probably good investment opportunities with a typo, and you stop and you think, there's a typo in the first paragraph. There's no attention to detail. Why would I give capital to this manager? So you need to have a very, very clear, succinct message. Here's what I'm doing. Here's what I believe in it. I'm generating alpha. I have most of my money in it. And we have an opportunity that requires a certain amount of capital, and we see the opportunity to grow. I've been on a bit of a breakaway, so you may probably have some questions you want to ask.
What do you see in any biases around that that you're getting to these numbers? Do you see any biases?
Yeah, well, there are many. There are positive and negative biases. I'd say there's a positive bias to investing in multi-residential.
Okay.
And we're in residential, and we're seeing new asset classes emerge, including single family properties, and single family properties that are benefiting from people wanting to have green space, and developers are taking a property and dividing it into two with access to green space that are perhaps not in the central core. Affordability and accessibility is an enormous issue. So there are capital biases to seeing strategies that can deal with affordability. There are biases to having an ESG strategy, and we could spend the rest of the discussion talking about ESG. And there are those that greenwash ESG and those that really believe in it. ESG could be many things. When we talk of the environment, and we talk about how a company treats its own employees and the governance, and these are really important topics. And I think anyone listening has to have an ESG strategy, and it has to be something that they believe in, as opposed to they kind of made up. But I think that there's an enormous bias to this. There are investors that are allocating capital to buckets that tick a number of things. A dividend, a multiple on invested capital, and in the vernacular we call that a moich. And I thought the guy that said moich the first time was kind of an idiot, because I didn't know what he meant. But it's a multiple of invested capital, and investors typically want to get 2 times moich. So that means you get your capital back plus your capital again, and that's equal to a 15% compounded rate of return over 5 years. But most investors want a 2 times turn on their capital. They want a dividend. Then you get into the detail of, how am I delivering this? Well, I have a multi-residential strategy. It's in Phoenix. The owner manager has been there for some time. They really know the market. They have their own capital substantially tied up in the strategy. They have an enormous opportunity to grow. And how do you grow today where cap rates are as low as they are? How do you create growth? So you need to do more than buy something and say, well, I'm creating value through cap rate compression, because arguably that may be behind us, at least for the foreseeable future. So you have to be able to create value somehow. And how do you do that? And you do that by being able to generate some of these alpha returns, thinking about things like, how do I generate revenue from community, from aggregating purchasing power, from providing higher services, by upgrading suites, by creating green space, by animating the physical building with things. And they could be a dog washing station, or it could be an event. And what's that balance between doing too many things and not enough? And again, you have to find the answer to that, but you want to create a community where people are prepared to pay a premium to be in your building, where you treat your resident like a client, where you know their name. There's a bias to doing this touchless. How do you use technology to improve the way that you run your business? Can you screen a prospective tenant without having to meet them, but still maintaining this sense of building a community? And the answer is yes. There's technology that can do the screening, the financial screening, and the accreditation or the qualification. How do you manage your business through technology? In using that hospitality example that I referenced, do you know what the rent is in your market today on the 1st of the month, the 15th of the month, the 29th of the month? In a hospitality model, you know what your rental rates are every day, because they're not the same every day. And are you positioning your suite as a function of the supply and demand in the marketplace? Really important that you price your product, understanding what the market is. And that's very much the hospitality model. You know, I knew the CEO of Four Seasons, and when he was hiring people for arguably one of the best brands in the world, and he created a brand, and they are able to charge a premium to an equivalent hotel through the service. And he would talk of wanting employees of Four Seasons who would pick up the phone before it rang. They knew it was about to ring from you. They'd pick up the phone before it rang, and they would offer the services that really were above and beyond the call of duty, and they were recovering that in their premium rate. So this is not about philanthropy. This is about offering services for which there's a return, and the resident benefits from that, and the investors benefit from that. And that's the center of the Venn diagram circles that I'm talking about, where you're intersecting the needs of the investor, the asset manager, and the tenant who's paying rent. And that's the simplicity of the deal. If you can do those things, then you're going to create an opportunity that people are going to want to participate in.
Yeah, I like the idea of not expecting the cap rate compression and really driving, creating the value through this. I love what you said about the purchasing power of 60% of the money leaving the building. And, you even hear decisions saying, let me sleep on it, right? All decisions, big decisions sometimes are made at home and right there in those apartments, as you said, subscribing right there in the apartments under our real estate, right? But 60% of that property or that income is leaving to other things, and that CEO of the future is needing to think more than cap rate, IRR, cash on cash, all that stuff, and think even in the areas that are around them, if it's other restaurants and these sort of innovative ideas. There was a story, I can't recall all the details, but it was about a casino in Las Vegas. And there was like a turnaround situation, but they were doing really well. I don't know, call it $4 billion in revenue, $4 million, whatever the number was, it was X. And they just asked the question when everybody was leaving the casino, like, where are you going? And they kept saying, this restaurant or this restaurant. It was always a celebrity restaurant. And so they're like, And and they were meeting the returns and they were successful, but they didn't know they were, maybe you told me this story, but they left some money on the table. And so when they brought in that celebrity restaurant, there was different branding, this collaboration with another brand colliding with their asset, and it just went off the charts. And they ended up, doubling their revenue or having a significant gain on it. That's that sort of alpha that you're talking about over just regular returns. So I'm wondering, how do you inspire someone to think like that, right? As an operator, maybe investors aren't asking those questions of them because they may not be as, thorough as you are. And then tying in Joseph's question here, which is like, how are you adapting a portfolio in sort of this, rapid shift in pricing and environmental concerns and all these things? So how do you think strategically on that brand and getting this alpha return, but at the same time, the target's moving so fast with just pricing and costs, this commodity approach,
You're asking a lot of things, but I think that that the key to any good strategy is building an optionality. So that and the key to real estate is what you pay for it, frankly. So if you have fundamentally good real estate, then your optionality is you can own it, you can improve it, you can sell it. I think a CEO has to, and I've spent time with board members who've said this to me. The CEO of the board I'm sitting on, we view him as the person who sits on the mountaintop and looks out for 3 years. And he has to look out and think, where are we going? What's the future hold? So a CEO has to think that way, but he has to execute today. And he has to execute today with all the risks of today. So he has to build, first of all, a capital structure he doesn't have to worry about. Having maybe a little bit more cash than you require. Being aware of themes and trends and being able to sort the wheat from the chaff, because there's a difference between a first mover advantage and being a pioneer. And they say, the pioneers, you recognize them because they're the ones with the arrows in their back. I had a client, and I think I told you this, who was still is a very good public company in the multi-residential sector here in Canada. And a number of years ago, they became a local cable company and telephone company. They actually got the licensing. And each of their residents were given a tablet when we didn't have tablets. And the market pushed back on it. Their investors said, what are you doing? You're a real estate company. You're not a cable company or a telephone company. So you have to dare to succeed, but you have to think it through. And am I so imaginative that I will be accused of having lost focus? But today things are changing so quickly, and technology is, and we can have another topic on technology, but I think that today a CEO has to be aware of some of the things that are happening. Certainly prop tech and fintech. Like we could have a discussion on, if you own multi-residential, should you even own it? Or should you just create a management company? Because the management company may have a higher multiple on value from your management fees than the value of the real estate company. So, and that's prop tech, fintech, where do you want to be? And then things like the blockchain. And the blockchain is not a four-letter word. The blockchain is going to transform the way we do many things, including real estate. And if you can take real estate, which is a hard asset, or for that matter, royalties or other assets, and record it on the blockchain, and you can record on it the history of the dirt, that, yes, there was a gas station here once upon a time, or there's never been a gas station, but that is an immutable record. And you can take the record of that dirt and the buildings that have been on it, and you have an immutable record, then you can break it into 1 million pieces and sell it and distribute the ownership through the blockchain, and arguably circumvent public markets and create ways for owners to access capital around the world, looking for the kinds of opportunities that I'm sure people on this call are working on. How can you access money that's resident in parts of the world today, and today's bad things are happening in the world. How can you access capital that's looking for safe haven in a multi-residential project in Phoenix? So these are interesting themes that I think are evolving and are, I call them nascent. They're kind of evolving, but as a bedrock to these themes is the residential sector, and this is what I think is so. Things. It could be a house, it could be a hospital, and everything in between. It could be seniors, it could be a trailer park, and a trailer park is a very negative expression for manufactured home communities, which happens to be a very, very, very attractive asset class, and arguably one that is not understood, which means that there's probably inefficiencies on your ability to buy it and the ability to enhance the value of it. And that's a residential asset class. So, I think the people on this call know residential, but there are evolving components of residential that I think are still in the earlier innings. It wasn't that long ago that institutions would not own multi-residential because they didn't want the negative publicity of actually raising the rent and having somebody complaining that they had no place to live. Same for the seniors sector. So, I think that there's still a lot of room to maneuver, but let's go back to what are we good at? And whatever it is that we're good at, if it's in the residential sector, as you raise capital, make sure that you're creating an opportunity where your investor feels that you're a trustworthy fiduciary of their capital and that you're aligned with the same outcome as them.
Yeah, so going back to, you mentioned a few key elements around even this, you mentioned blockchain and some of these other things that are coming at us or opportunities ahead for those that can figure it out. You mentioned dare to succeed, but think it through. I loved that. But I will ask, how do you innovate without taking on undue risk?
I mean, you're asking a question that has no kind of linear answer. I think that strong managers have the strength of their vision. I like to say, like, I know what I know. I have the confidence of what I know, which gives me the confidence of what I don't know. And if you're a confident owner manager in what you're doing, then you should be confident in asking questions of people that maybe know more about something than you know. And don't be embarrassed because you're confident in what you know. So have a board, have people that you can turn to who know things that maybe you have less experience in. Talk to people who have experience in raising money. And I don't know that companies necessarily have to be themselves specialists in raising money. They have to be specialists in running the money, in deploying the money and giving it back. So have people that you can talk to that can help you raise money and they can help you with the structuring. And structuring is not your NOI margin. It's what's a fair return to me managing your capital? How much of your capital can I take? What's fair? And have people on your board. Have an advisory board. It doesn't have to be, it can be an advisory board where those advisors are not on a formal board and they're not taking on liability. Have an advisory board. Have people you can turn to and who you can trust. And the problem with being a CEO is it's very lonely. And you can't say to your CFO, I don't really understand what you're saying to me. And you probably can't say that to your chairman either, because the chairman is going to say, I think I have the wrong CEO. You need to have people who are either formally involved on your advisory or informally involved, so that you can ask the question that you just asked me. What is it that I should be asking? What is it that I might be missing? Am I too focused on my existing model? How do I take this model and actually change it? And I own all this multi-residential. Can I turn it into something else? And you're seeing this now with owners of shopping centers who are saying, geez, maybe I don't want to be what I was, but I have this really nice piece of land in a city center or in a good location. Can I build residential on it? Can I build seniors on it? And we're seeing that happen. Can you actually go to the owners of shopping centers, the CEO, and say, I don't know anything about shopping centers, but I know that you have some really good land, and that maybe we can take part of the parking lot and build a building on it that's going to be purpose-built multi-residential. Maybe it's a condo, and we're going to share in that. We actually are creating, people are going to come and buy stuff from what's remaining of your shopping center. But these are, how do you take your idea and share it with others that can't do what you do or can't do it as well as you do? So that's a question you have to ask yourself, and then make sure that you're asking questions to people that are smarter than you, where you're not ashamed to say, I don't know, I really don't know that much about technology. How can I, what is the blockchain? How can I use it? But ask the questions, but don't lose focus. And we talk about, I've got a couple of clients I'm working on right now that have some really big ideas. And you want to convey a combination of, this is a very scalable idea, could be globally scalable, but I have focus. Like I have a swim lane that I'm swimming in. And someday I could actually use the other lanes too. We could actually expand. We have an idea that's expandable, but accuse me of being focused, and accuse me of having options. So having that kind of scalability, and that's both in terms of size and taking an idea and bringing it into other aspects of your business. And in the residential sector, could be into buying houses and dividing them into 2 rental properties. It could be approaching a shopping center owner and or the owner of a piece of land and partnering with them and saying, I'm going to actually enhance the value of that land. That land is worth much more than what you're doing on it. And we're going to do that together. You could try to buy it from them, but that's tough. Partnering is another option. But again, now you're creating options. You're creating different ways to advance because what you don't want to be doing, and with all due respect to the brokerage community, because they're very important, you want to avoid being involved in a bidding war that's been laid out through a very efficient broker. Ideally, you're seeing the off-market deals. You're creating your own deals. You have people calling in deals to you because you're viewed as being very good at what you're doing. You close, and maybe them calling you, it's so that they can share in the deal with you. They actually will become your partner. Isn't it a great strategy if the market knows that they can bring you their asset and you have a strategy that can allow that asset to become more valuable to them as well as to you, and that you can share in that upside? We tried to convince on the multi-residential legacy owners of apartment buildings, to sell their building to our public multi-residential clients and take back shares. So they would take back shares in the company that was in the same asset class and post-transaction, including their building, but their ownership was now diversified against the whole portfolio and with a more efficient capital structure and the purchasing power and all of those things. So these are all ideas that could be helpful.
I love the way you share. You're great at explaining things, and I love the idea of bringing in. Don't be afraid to bring on that advisory team or ask for that help. You don't have to know the how, always just the who, in many cases, and really refreshing. I know you and I could spend a lot of time together to go deep on a lot of different things. We have time for one last question, and it's probably maybe even better for our ESG session. But how close are we, this is a question from Joseph, he says, how close are we to environmental issues influencing financing costs, and is the market adapting fast enough to be resilient to a to rates, basically rate hikes? So, are we close to that now? Are you seeing that influencing issues on financing?
So again, I can answer this at many levels. I'll make a couple of quick comments. First of all, the multi-residential sector is a sector that governments want to see expand. They want to see more multi-residential. And I think you have access to more favorable financing because of that. They want to create financing that will accommodate accessibility and affordability. And in Canada, we have something called Canadian Housing Mortgage Corporation. It's the cheapest debt that you can borrow. And it's because of the need to build more houses. So figure out what that means for you in the multi-residential sector. As it relates to ESG, I'm working with a client right now that has been planting trees for 8 years very successfully around the world. And they want to create a for-profit platform that will allow them to actually plant more trees because they will own or lease the land. And we're talking about their favorable access to government financing, because governments want to see housing. They want to see that they can achieve their carbon objectives, and we're moving towards a carbon neutral world. So ESG, I think, will afford very attractive financing for those that actually can participate in and create product that sequesters carbon, that then leads to the trading of carbon offsets. And this is something that I'm working on right now, because I can tell you with certainty, I don't know what a carbon offset is worth. And so I know that there's going to be positive inefficiencies in that. So how do you take your skill set and be in asset classes that the values haven't been driven so high because cap rates have gone so low because there's so much capital competing. So I'm very confident in the ESG space that there will be and is access to favorable financing, because there is such an enormous desire that there are projects that will be created that will reduce the production of carbon or will sequester carbon.
All right. Thank you, Craig, for that. This has been refreshing again. Love sharing the time. I know we probably have many other follow-up sessions. And just, again, thank you for carving out the time for this. This has been amazing.